Everybody, it's Lane with the SimplePassiveCashflow.com podcast. If you guys want to learn more about investing, go to SimplePassiveCashflow.com. But today got George Newberry. He is the CEO of American Home Preservation, or AHP for short. He is sponsoring the Simple Passive Cashflow podcast, but more importantly, I personally invest money into this fund. And George, it literally puts my car in the parking lot for me. It pays 12% a year. So take that stock market at your paltry 8 to 10%. It is backed by real estate, and 12% a year is 1% a month. And that gives me just enough to pay my car lease.
I'm very glad to hear that. No, I'm very glad to hear that, Lane.
So just a
Keeping
little
you rolling.
Yeah, it keeps me rolling. So from people who don't know about AHP, what they do is they buy notes. They buy the distress notes type, and we'll talk a little bit about that. And they're kind of pushovers in terms of negotiating. They just like to keep the homeowner in their home. So they're doing a good humanitarian effort there, and they modify the home of the people that they buy their notes at discount. And it's a kind of a win-win for everyone. Me personally, I like to invest in AHP as a sort of holding tank, or I call it the opportunity fund. So when bigger and better deals come around, I like the liquidity to take my money out and put into something bigger and better. And the interface is pretty sleek and like clockwork. That 12% comes in my bank account every month. It's like I have well, not quite like I have another paycheck, but it's like I have a small person working for me doing small tasks here and there.
I'm glad to hear that.
So thank you, George, and let's tell the folks about American Home Preservation, which you guys can go to investinahp.com for more information.
I appreciate that, Lane. So here's what we're going to talk about. We're going to talk about AHP in general, and then I want to talk about an offering that we're working on right now, which is we're purchasing 799 mortgages next week, and I want to share the news and share what we're doing. So here's what we do. We're a nationwide buyer of non-performing mortgages. Now let's talk about what a non-performing mortgage is. This is a mortgage that some family or individual took out, and for whatever reason, they're now unable to pay. And so this would be a first mortgage, just like banks. In most cases, these are originated by some of the bigger banks in the country: Bank of America, Citibank, Chase, and now they, for whatever reason, the families or individuals have stopped paying, and now they become non-performing. And in many cases, these families haven't paid for years. And these are kind of the hangover from the housing crisis of almost 10 years ago. And that's what we buy. And our focus is those mortgages secured by homes in low and moderate income neighborhoods across the country, and issue loans that are litigation, title issues, code enforcement, and different types of issues. The market, people think, hey, the foreclosure crisis, that's come and gone, and certainly you can say that for some of the higher income, in middle and higher income neighborhoods across the country, where there's been some appreciation in the last several years. Many homes that were underwater are no longer underwater. That is not the case in many low and moderate income neighborhoods across the country, where there's been very little, if any, appreciation, and those families in those neighborhoods continue to struggle. So we try to find solutions for them. We've acquired more than 3,000 loans since 2011. Our returns have averaged over 20%, and our social impact has been significant. We've helped more than 1,000 families stay in their homes. We've taken more than 1,000 vacant homes and returned them back to service. And we've extinguished more than $100 million in negative equity.
Yeah,
Finally,
so this type of investment is in the notes world. So I mean, a lot of on SimplePassiveCashflow.com, you guys can learn about turnkey homes, syndications. A lot of us are buying coffee farms in the next couple of weeks. June 8th is the date on that for you guys listening. We need to send our forms in for that. but even more on the passive side is this notes. So that's kind of what we're talking about here. It's a very passive investment, and George is doing it on a huge scale here.
Yeah, so notes. Well, if you have us buy them or you invest in a fund, it is very passive. You're simply getting a return each month if you buy your notes directly, or certainly what we do. For us, it's very hands-on and very active, and we have a team here that 2 attorneys, 3 paralegals, 2.5 servicer personnel that are working that exclusively work on working these loans out. So it's a lot of work, and but it definitely has rewards. A little bit of our history. We started out in 2008. We were a 501c3 nonprofit. Our focus was keeping families at risk of foreclosure in their homes. We've since transitioned to for-profit, and we now offer work. Despite going to for-profit, we still have the same mission, which is to keep families at risk of foreclosure in their homes. And we actually find that we can be more effective as a for-profit. And we actually, last year, the Securities and Exchange Commission qualified our Regulation A+ offering, which allowed us to offer our investments not only to accredited investors, but also to non-accredited investors, and to make it cast the net as wide as possible and make it our investment accessible to as many potential investors as possible. We dropped our minimum investment to $100, so it truly is very accessible. These are, like I said, these are a lot of work. We buy lots of times the loans that other funds and banks don't want. We buy these at an average of less than 50% of current market values of the properties that back these mortgages. Many times it's even less than that. And it takes a lot of work up front in order to make sure that you're buying right. So we have local agents do broker price opinions, which are basically valuations. They drive by the properties and they come back to us and say, hey, we think this property is worth $50,000 or $100,000 or whatever the number is, and provide photos and other backgrounds information on these properties. Now that is, those are simply their estimates. We have to do our own research to kind of validate what the agents come back with, validate or adjust it as is appropriate. We also research title on the property taxes, and we review the collateral files, which are basically the loan files, the documents that the homeowner first signed when they took out the loan. And in this case, we're buying the 799 loans right now. The lender is bankrupt. All the files are sitting in a warehouse in Texas, and they wouldn't allow copies to be made. They didn't have any image copies, so we actually had to fly two of our team down to Houston to review these files in the warehouse in Texas with no AC for 4 days, which was quite a bit of work. I'm often reminded that there was no AC. But the amount of work that you do up front is really very, very important, or we found it to be extremely important. I mean, there's big risks in buying these. If the valuations are inaccurate, if there's undetected property damage, for instance, you drive by the property, the agent drives by the property and says, hey, this property looks like it's in decent shape, and then we get a deed in lieu or foreclose on the property, and we find out, there's a big termite infestation. Now, in fairness, the agent probably couldn't pick that up, so that's something that's just a risk, and once in a while we get hit with it. There could be vandalism, title issues, delinquent taxes, missing documents. These are all things that are fairly commonplace in the loans that we acquire, and as long as we can identify the deficiencies beforehand, then we can go to the seller and try to get them to further reduce the prices because of the issues that we detect. And as a result, if we buy right, we're typically going to make money. So that's how it works. But the key is uncovering those issues before we buy.
So you're picking up a lot of these homes in big pools, and better pricing for the unsophisticated investor out there who wants to dabble in some of these notes. I mean, that was a problem when I ran to when I started to look at note investing. I ultimately didn't do it because you don't have the leverage. That's the beauty of real estate. But for those of the who want to specialize it and get good at it, like, I mean, that's the problem, right? When you're first starting out, like, who do you buy these things from?
Huh. No, it's a problem for us even. I mean, so the problem today in this market is that there's a lot, just like in real estate in the high, moderate, mid, and higher income neighborhoods, there's a lot of competition, which has driven the prices up. And so it's tough to find good buys. And so if you're a retail buyer trying to buy, you'll probably find people willing to sell you stuff, but it won't necessarily be at particularly attractive prices. And as a result, it's tougher to make money. We could buy a lot more loans than we buy if we paid more. The reality is we're not that competitive in today's market, but when we find kind of oddball situations like this one, the lender's bankrupt, we had to do all our due diligence up front. There were clearly a lot of issues with the files. You had to put up $100,000 deposit when you made your bid, and there had to be a final bid. So there were a lot of impediments to other buyers getting involved, and as a result, we were the only bid. And even then, they said our bid was too low. We had to negotiate a little bit higher up, but it was still a good deal. But it points to, I get somewhat concerned at times that we just will not be able to find enough product to buy. We're buying the $799 next week. We bought 4 loans on Friday. We bought 477 in March. So as long as we continue that kind of rate of buying, we'll be in good shape. But there could well be a lull. But if there's a lull, so be it. We have plenty to work on, and at some point, we establish a reputation for buying these kind of more difficult loans, and at some point there'll be more, and we'll be there ready to buy. It's much better, in my mind, and my experience tells me it's much better to wait for the opportunities than to get impatient and overspend, and for mediocre opportunities, and then when the good ones come up, your resources are stretched and your money's out the door. So wait for the good opportunities, and when they're there, strike.
Right, and that's some guy wrote a book called The Art of the Deal, and that's pretty much you name your price and you just wait, right?
Yeah, exactly. It'll come there. I mean, it's funny. You see a friend of mine, and some people, you hear about them selling their companies, and then they sell them at the height of the market, and then they know the buyer probably overpaid, and then they just wait, and at some point they're buying back their companies. I mean, you see it all the time. There's even real estate. You can see where you buy it at the bottom of the market, you sell it at the top of the market, and then you're there to buy it back. I mean, people forget there's a cycle to all these things, and clearly I think right now we're at the upper end of the cycle. And actually, the slide that we're on will show you 2 ends of a cycle. So this is an example of a loan that we purchased, and the homeowner took out a loan in 2003 for $164,000. I mean, this home was worth in 2007 $200,000. In 2010, after the crisis had started, he was laid off from a 17-year job. So all of a sudden, his property value started to sink, and he was also unable to pay because he was laid off. And the property value fell all the way from $200,000 to $32,000. I mean, that's just dramatic. And he tried to get a mod. This loan was being serviced by Aqua, and he tried to get a modification. They denied him the modification. They scheduled a sheriff's sale. Luckily, the investor decided to sell this mortgage in a pool to AHP, and we bought it for 30% of the $32,000 value, so $9,600. And we went to the homeowner and made a deal. We gave him a modification. We took $2,000, which we applied to the delinquency, and we forgave the difference. Again, he hadn't paid in several years, so we forgave tens of thousands of dollars. And his old payment, which was over $1,000, we dropped it to $320. So it was, I think he thought it was too good to be true, but in the end, he happened to be in near Chicago, so he came in, believed it, we signed the deal, and he was thrilled, but we were thrilled too. I mean, look at the numbers here. In the first year, we got the $2,000 to cure the delinquency plus 10 $320 payments for a total of $5,200 on a $9,600 investment. And so 54% return. And we still had 18 years to go of $320 a month in payments, so over a 40% annual return. So the returns were extraordinary, but also the homeowner got an extraordinary deal. So everyone won. The only person that probably lost, or only entity that lost, was the bank who originally made that mortgage for $164,000. There, someone took a hit, but it wasn't us. I mean, we benefited from that, as did our investors, as did the homeowner.
Right. Well, good for those banks. They're the ones that made those dumb mortgages back in 2003, right?
Absolutely.
So you got some good numbers, and this is probably one of the more typical exceptions. But on average, what would you say you're buying the loans at? If you've got like $100,000 home in 2007, just use round numbers. What are you typically buying that at?
It's often, we're typically buying maybe around 20% of the unpaid principal balance of what people owe. 20%, could be as high as 30%. But I mean, on this pool that we're buying right now, the 799 loans, it's at 7% of the unpaid principal balance. So 7% of what's owed is what we're paying. So it's just a huge discount. And if you go on the property value, at the time those loans were made, it's probably 5%. So truly a fraction.
What are the amateurs paying on the retail level for these loans?
Well, it's not just amateurs, it's professionals. I mean, we've seen pools trade in the 60s, 70s, and 80s. And so those are, there's people paying a lot more than we are. I mean, so here's what happened on some of these loans. Like this loan will, we get the homeowner to pay for 6 months or 12 months, and they build up a payment history, and then we can sell it back to some of these funds who are willing to pay 50, 60, 70% for a reperforming loan. So that's something that it's not our goal to sell these, but when the prices are so high like they are today, we establish a payment history, resell them. We're more than happy to hold it, but when those bids become so high, and in my mind, those bids will be a lot less in a year. So in a year, I'm probably we're going to modify these loans and hold them. Right now, the market is in a frenzy almost to buy these things. So we will, once we fix them up and we get the loans back in order, and so we'll sell them as long as people are paying what prices that I think are too high.
Right. You take your 54% in the first year and sell it and move on to the next one.
Exactly. And they'll buy a loan like this for, $20,000 or something like that. And, again, we paid $9,600, we got $5,200 back, and then we get 20, we're not doing too badly.
Yeah. So I tell a lot of people that, we're all looking for the hedge, right? Because we all agree that the next correction is coming in the next 6 to 18 months, or, for all we know, it may be another 4 years, but like what happens in a recession? I mean, like for the turnkey houses, that's why you buy them with cash flow, right? Because in a downturn, you don't care what it costs. You just care about cash flows. But talk to me about the nuances of what's happening here with these non-performing notes and what the AHP is going to be doing.
No, I share the concerns. I would think I always call it early. I always step to the sidelines early because I think the market's bad. But right now, we're not competing on traditional note pools because we don't pay enough. We have to find the kind of oddball pools where we can add a lot of value, such as the one that we're working on right now. But what'll happen is once the market goes down, the opportunities, the supply of product will go up and at attractive prices. So I want to be there, not burdened by stuff I overpaid for. So I'm going to, once this market goes down and the supply is there, then hopefully we're spending 50, 100 million at a time in buying these things. And that's why I want to put out a lot of money. In the meantime, we're not putting out that much money, but we are getting great deals. As you'll see by, we'll talk about our returns shortly, and the returns have been exceptional, but that's strictly, we make money when we buy these things right. And then we're able to share that value with our investors and with the homeowners. If we pay too much, it's bad for everybody. If we buy it right, it's good for everybody.
I think I just want to point out to the people listening that, a lot of people are fearful of a next downturn. And a lot of, a good portion of very sophisticated investors will say, well, okay, now's not the time to buy anything. But then you don't know if that's going to continue for another 4 years, and then you just missed out on 4 or 5 years of a bull run. I think that you've got the right mindset, and something that I've been trying to do is underwrite the deal so that you make your certain percentage, but don't extend yourself over that. Always be buying, but buying the right thing.
Yeah, and so sometimes you're buying, you'll just wait. I mean, there was Donald Sterling, the ex-owner of the Clippers. Certainly had some issues, but in terms of buying real estate, he was extremely successful by doing, by setting his price. If someone came to him to buy an apartment building, he would say, okay, I'll pay X. And people say, oh, that's not enough. But in a downturn, if someone needed to sell a property fast, he was always there. He was a very reliable buyer. And that's what you want to do. You don't want to be in a situation where someone comes to you and says, hey, buy this. And you say, well, I'll pay X. And they say, oh, that's not enough. And then you go, okay, well, I'll pay X times plus 20% or whatever you're paying. Increase, trying to get to the market. Decide what number you need to pay in order to make good money on that deal. And if you can't do that, just pass on the deal, because there will always be more deals. Nothing is once in a lifetime. There's your lifetime, you'll see a number of deals. And the worst thing to do is to overpay at the top of the market, and arguably it is the top of the market right now. So if you overpay right now, then chances are you will not make a lot of money, and you also may lose money. And you not only lose money, but when the downturn comes, now you're worrying about kind of maintaining what you have instead of taking advantage of all the opportunities that become available in a downturn at attractive prices.
Yeah, you're gonna chuckle at this, but me and my partner have been looking at these smaller apartment buildings from like 16 to 60 units, and they're just not penciling. I mean, a lot of them are like, they'll be like $4 million, and somebody else will come by and offer 6.5. It's just crazy. And the property management companies are telling us, hey, you guys have it right. You guys are underwriting the properties right with your 20% a year for 5 years. And don't fall into the frenzy like all these other people. But it's just like, it's frustrating because you want to do deals, but you're just kind of sitting around doing nothing.
Find something else to do. I mean, find a hobby.
I mean,
yeah. The thing is, there's always deals. We talked, you and I talked about this before, but there's always something where there's code enforcement, some chaos at a property, or it's just someone's lost control of it. I mean, you have to really work to add value to those situations, but those are opportunities will be in every market. I mean, in every down market, up market, there's always going to be some severely distressed asset or assets. I mean, we get them. We get REOs here where the city's saying, hey, if you don't get this fixed up, we're going to start proceedings to tear down the property. And the property's in Chattanooga, Tennessee, and here we are in Chicago. So we get that REO. We're trying to tell the agent, hey, find a buyer, get this thing done. And we'd certainly be obviously agreeable to taking a very attractive price because there's a problem. And we're no different than Aquin or Bank of America, Wells Fargo. Anyone, once you see those signals of like, this is a meth house, or there's big code enforcement issues, or we had one not too long ago where the plumbing downstairs busted and it had was causing some instability on the neighbor's foundation. So those stuff you got sell. So I would encourage those opportunities are always there. And when you're in an up market like this, find those kind of exceptional opportunities. If you can't find them, wait till the down market happens. I mean, like you said, find a hobby but don't overpay, because that's where people always lose. And then what happens in real estate is they overpay, then they can't sell for what they need to, then they just rent it when they really intended to sell it, and it just all turns out badly.
And for those of you who have you've seen George before, he's been on the Simple Passive Cashflow podcast, episode number 34. George Newberry goes $28 million in the hole in the fight to get back to even. That was in a previous life where you were apartment investing.
Yeah, exactly. I had 4,000 units at one point, tens of millions in net worth, and kept going bigger and bigger. Started out with 4 units, and 16, then 60, then 298. Then pretty soon I was buying one of the largest complexes in the country, which is 1,100 units in one complex. And an ice storm hit the property, and battled with the insurance company and the city, and it kind of undid me. Not kind of, it did. You learn a lot from that. But certainly one is discipline. I don't think I certainly bought the property right. But I guess it tells you, even if you do everything that you think is right, things can still go wrong. No one anticipated the ice storm and the extent of the damage, and the fact the insurance company wouldn't pay, and then the city official reaction. So it was a chaotic time. But the bottom line is, you find that property was nicknamed Uzi Alley. It was in bankruptcy. There was a lot of problems where people didn't want to buy it, and yet here I came along and bought it, and added a lot of value to it. So those are the types of situations, any type of market, real estate, businesses, find problem situations and buy them cheap and add value.
And that one, people want to Google that. That was Woodland Metals in Indianapolis.
It was actually Columbus, Ohio.
Columbus, Ohio.
And if you want to, you can Google it and see snippets of all kinds of crazy stories online. You can also, if you want to email your mailing address to Lane, I will send you a signed copy of Burn Zones, which is a book I wrote. Which
you're signing them now?
I sign them now. And they actually, it tells you the whole story of what happened, the good and the bad. At Woodland Meadows and Aftermath, there's a chapter on how we started AHP. It's a fun story. And also I think it'll point to some risks of, being an entrepreneur and being a real estate investor, and also to the rewards. So it's certainly send your mailing address to Lane and let's get you a copy.
Yeah, if you guys want to check out that, it's episode 34, if you guys want to go back in the archives.
All right, let's see what we got. Okay, so there's, as we said, you can make and lose money, just as in real estate, just as in notes. Now we've been making money. Our current offering was qualified by the SEC. We filed our audit last month. We paid investors 12% in 2016. Our total returns were 39.71%. So we did well, and we did well, as Lane said, by being a pushover. And so the pushover is we reach out to homeowners, we're respectful, we offer them simple formulaic solutions. For instance, a family in New York and a family in California, if they both live in houses that are worth $50,000, they are going to be offered an identical deal. We make this as simple as possible, as minimal documents. We're not asking families for tax returns, bank statements, hardship letters, paycheck stubs, and all kinds of documents. Which is commonplace for most other servicers and lenders. And we found that many of the families, especially at this point in time, if you say, hey, great, we say, we'll do a mod for you. And they're saying, okay, I've heard that story before. I applied at Bank of America, then at Ocwen, and then at Flagstar, and they all denied me. So why is this time going to be any different? I'm not going to even go through the effort of putting together all my documents. So we just say, we don't want the documents. If you give us $2,000, we'll settle your delinquency, in most cases $2,000, and then here's what your new payment will be. If you want to do it, that's great. If you don't want to do it, you don't want to stay in the home, we'll give you X amount of dollars, maybe $1,000, you sign a deed in lieu. So whatever they want is what we want. We've learned not to force a solution on a family, just give them their options. They get to decide which one, and that's really how you make money in this business, by achieving consensual solutions with minimal legal costs. If you have to foreclose, you use foreclosure as a tool to provoke a response from an unresponsive homeowner. Hopefully they'll get the foreclosure notice, say, oh, this is serious, now I got to do something. They'll call us, they'll make a deal. We even have, we had so much trouble overlaying our strategy with different servicers that we finally made a deal with a servicer that we have two full-time employees and one half-time employee that work strictly on our loans, our portfolio of loans, because if we just had their regular servicing pool all working on it, it was difficult to overlay our simple solution with the much more complicated solutions that most of the other lenders require. All our loans are held in a trust, the trustee is U.S. Bank. This is wise for a number of reasons, but the biggest one is most states require that loans are held in a licensed entity with an exemption, typically for loans held in a trust with a national bank trustee. So we've learned how to make money, being a pushover again, or as opposed to how to lose money. It's very, very easy to lose money in this business. If you're aggressive in collections, we do see these some buyers come into the market and say, hey, if I can buy the note at 50 cents on the dollar and then I can foreclose and kick out the family, that's a lot cheaper than buying an REO. So that's what I'm going to do. The problem is if you buy that note and the family doesn't want to go and you want them to go, then you're likely going to end up in court, and that can be an extensive, it can go on for years. In the meantime,
that's kind of a ethic. That's kind of not very ethically moral, right? I mean, a lot of note gurus would teach that, find these types of situations so you can foreclose them and kick them out and sell it and flip it.
Absolutely.
That's not what we're going for here.
No, totally opposite. I mean, you have to be, if you're going to buy notes on your own, you really want to be prepared to do what the homeowner wants. And if you can achieve consensual solutions, there's plenty of homeowners that have already gone, the homes are vacant. So that's the home that you want to get REO, that will become REO. But if it's occupied and you want to force the homeowner out, legally you probably have the right to do so. But it's, as Lane touched on, morally, ethically, it's more challenged. And the reality is there's some good foreclosure defense attorneys that if your borrower connects with them, they will make it very expensive and time consuming for you to foreclose on that home. So at some point in the process, you might just say, okay, either I'm going to sell this loan or I will do the mod. So why not make that deal up front? I mean, people, I was quoted in Bloomberg, and basically it's, you don't have to litigate with us to get a good deal. We'll give you the good deal up front. So we are, in fact, I'm going to add to the next slide, we're the pushovers, just, and it really is. We tell them from the day one, they'll get a letter that, hey, you haven't paid your mortgage in 3 years. You owe $20,000. Give us $2,000. We'll forgive the difference. Your old payment was $800. We'll drop it to $500. We'll make it very, very attractive for you to stay. But if you don't want to stay, we'll give you $1,000. So either you pay us or we pay you, whichever you want to do. But we'll, and we do these in the matter of days. If they say they want to do a mod, we'll get the mod out to them in a handful of days. If they say they want to do a deed in lieu, we'll have a mobile notary out to them within a few days with a check in hand. All they have to do is show their ID, sign the deed in lieu, they get the check, we get the property, and it's done. We don't, if you go to Bank of America or Ocwen, they're going to take months and months and months to get these processes done, and which just loses them or their clients money. So it really makes a lot of sense to get these things done fast. And the way we do it, I'm surprised no one else does it like this. Because the reality is these loans, a non-performing mortgage, completely unlike real estate, will lose value every single day that it's not performing. The property is going to deteriorate. In most cases, the family that's not paying is also not taking very good care of the property. Property taxes are typically going unpaid and will increase every day. So rapid resolutions are absolutely critical.
And you're being a pushover, and it seems like they say nice guys don't finish or finish last, but looks like you're making a nice 40% per the SEC audit, huh?
Yeah, exactly. It's a unique circumstance where you have a business where everyone's winning. So here, the homeowner, we share the discounts. We get a great discount when we buy these homes or we buy these loans. And even if that lender's losing a ton of money, they're still agreeing to sell it. So we're giving them a fair price and predictable price. But the homeowners, that discount that we get is shared with the homeowners to give them a transformative solution, and also with our investors to give them a good return. So it really is, win-win-win. Sounds cliche, but you can really see it in play here. Here's another deal. This is the deal that we're working on right now. 799 first mortgages. The lender is bankrupt. The total debt, $43 million, an average of $54,000 per loan. we're buying these loans for $2.875 million. Just that's one of our best buys ever in terms of the percentage of debt. $3,500 a loan. Our average home value is $43,000. We only did valuations of 12% of the pool to get us comfortable, but those are very attractive numbers. Many of these loans do have issues, though. That's why we're buying them so cheap. They have tax problems, title issues, code enforcement issues. And these are things that we have 2 attorneys and 3 paralegals that work in our office full-time every day, just working on resolving these loans and kind of patching them back together. Our investors, what do they get? They get the first 12% of what we make. So 12% return to investors. We also offer liquidity. So if an investor needs their investment back at any time, this is from our offering statement, we will use commercially reasonable efforts to purchase or arrange for the purchase of the investor interest. So basically, either we'll buy it back or we'll find an investor to buy the interest. And we've typically been able to do this within 30 days. We've had redemptions from $400 on up to $300,000. We've always been able to get them completed within the 30-day request period. And a few times we even had people say, oh, I need the money back in 2 weeks. Can you help out? And we've always done our best to accommodate those requests. Again, it's best efforts. There's no guarantee to any of this, but it's something where we have a good track history of generating these returns and providing that liquidity. And who can invest? Both accredited and non-accredited investors. Just about anyone can invest in this offering. Minimum investment, $100. So we make it as accessible as possible. I mean, $100. Some people who probably went out to dinner and the movies this weekend probably spent more than $100 just doing that. So it's a very accessible investment.
And so the 12% returns. I mean, we've joked at one time that if you you could probably, like you said, you're making 40% a year, so the money's safe. Per the SEC audit, that people can go and Google on that. But there's a spread in there. There's a factor of safety. I mean, you could probably pay out 14, 15%, but then people will start to question if this is a scam or like.
Yeah, they think it's too high.
Yeah, people are used to 6, 7, 8% in these type of investments where you've got a hard asset, which is a first mortgage, not the second, not the third, the first mortgage. And this is what really like riles me up about the investment is people think that 6 to 10% is the range of investments, and this is why I created Simple Passive Cash Flow. You have this wide range of passive investments, from turnkey houses to apartment syndications to coffee farms we're buying in June 8th. You guys need to get your forms in for that one, and then notes. And I tell everybody that once you do a little research, it doesn't take too long, but once you get in it, the bronze level of this stuff is 12%. And that's what George is offering, 12%. It's super passive, it's infinitely scalable, and it's 12%. The layman out there will think that this is crazy, 12%, whoa. But this is not new stuff. This is like the bronze level of investing. Apartment syndications make 15 to 20% a year, and if you want to do some passive turnkey stuff, maybe do a little rehab, you can make in 20, 25, 30% plus a year. I mean, I don't know, it just frustrates me how the dogma has marketing has changed people's perceptions to make them think that 6 to 10% is what you should be getting. And
well, you can see it here. I mean, we've been achieving those returns for more than 5 years. Since we started, which was actually 2011. So it's definitely out there. But like you said, I mean, what's odd here is the homeowner sometimes think, hey, your deal's too good to be true. Sometimes the investors say the same thing, hey, the deal's too good to be true. But it's what we do. We have a good history of doing it. And as you said, I mean, our recent audit, with Regulation A+ that we operate now, that audit needs to be filed with the SEC. All our filings are online both on the SEC's website, and we put the audit on our website so you can take a look at it. But it's something that it's helpful to validate the fact that, hey, these returns are real. and it can be something that that just about anyone can help Sharon.
Yeah, I know. I like to put some money into here and use it as an opportunity fund. But I'm a little different than most investors. I'm a little more active than most investors, but I guess if I'm thinking of my normal avatar, like engineer, doctor who's got about 10 or 200,000 or $100,000 cash to invest. Yeah, you're waiting for a nice, sweet single family home or to put in 50 grand into an apartment syndication. But, like we just were talking earlier, the deals are so hard to find. Money is easy. Money's pretty easy to find these days. But this is something pretty good to park your cash in for the time being. Until the nice sweet deal comes around that you can properly vet and then get the liquidity and put into something bigger and better.
Absolutely. And those deals, oftentimes people always want to know they can get their money back, but many a times people end up not needing their money back as soon as they expect, especially in today's market where good deals are tougher to find. That money, you may as well have it sitting in here earning 12% versus sitting in the bank and earning 1 or 2%. So we welcome all your, Lane, we welcome your listeners to participate. Hopefully, some new, as a result of this webinar, hopefully some new Simple Passive Cashflow community members will discover AHP and want to learn more. You can go to AHPFund.com or invest with AHP to learn more, and we welcome your participation.
Yeah, and I would say just try it out. I mean, like anything, the good thing about with these investments, it's it's all through the SEC. But you never know. I mean, try and put some money in there, see how it works, and I think the important thing is people wean themselves off of the mutual fund and stock market stuff, because that's really where the crooks are at. I mean, they're making 20-30% a year, but they're only giving you like a small percentage of that back. And I think that's what this is all about. And this is crowdfunding the mortgage crisis in America, and this is the way investment is heading.
Yeah, absolutely. You see more and more funds. I mean, to be clear, this investment, as are any other Regulation A offerings, we simply get qualified by the SEC. You go back and forth with the SEC on your initial application, and eventually, if you're successful, they qualify you, which simply allows you to offer, and then you need to, on a regular basis, file your annual report and your audit and different reports. But it creates a fair amount of work, which I think weeds out some of the less persistent and probably maybe less viable investments. But it's something. The biggest thing for us on Regulation A Plus was the ability to accept non-accredited investors. It always seemed a little bit odd that we were helping the rich, because previously we did multiple funds which were only accessible to accredited investors, and it was the rich helping the poor, which that's fine. But now anybody can help. So if we help a family, they could actually now they've secured their housing situation. Now, ideally, they could help another family. They could participate in AHP and help another family. I mean, that's the ideal. So kind of the 99% helping the 99%.
All right. So you go to investinahp.com, guys. Consider it as part of your portfolio. Different levels of involvement here. You don't have to go in and do flipping. You don't have to go and do turnkey houses, but this is along the path. It's a lot passive than these other things out there. The returns aren't as spectacular, but it's a good, solid investment that is backed by real estate.
I appreciate your time today, Lane.
All right. Thanks, George.
All right. Thanks a lot.
Bye, guys.
Have a good night. Bye.